Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus. Thank you for joining us for another episode today. For those of you watching on YouTube, I don't think there's a whole lot there, but we've been talking a little bit about some of my things going on in this whole eye surgery. So you can see that that eye is not quite open yet, but that's not going to keep us from charging forward. So today, we're going to be talking about what's changing in construction costs here in the middle of 2024. A lot of this, I'm going to give a shout out to 𝐥𝐴 Architecture, who's somebody who I follow on LinkedIn, because they have these great reports kind of what's going on in the construction business. And why is this important? Well, as we're looking at a lot of things going on in commercial real estate today, construction costs are still a huge part. There's a lot of talk about interest rates and such, but a lot of deals right now really have a hard time working because of fluctuations in construction costs. As we all know that construction costs really shot up during the pandemic. What we're starting to see now is material prices stabilizing, but they're stabilizing at significantly higher prices. And in most cases, the supply chain recovery's in full swing, with lead times returning to near historical norms. But there's still some outliers here, and we'll get into this a bit more down in this report. Contractors' backlogs. Again, this can affect costs because if contractors have long backlogs, they can afford to charge higher prices. If they're scrambling more for work, we'll see lower prices. They, especially in the industrial and manufacturing sector, contractors have remained busy, particularly in things like computer chips, electronics, high tech, electrical manufacturing, data centers, logistical centers, which we talked about recently here in Utah, and fulfillment type facilities, which are really your last leg distribution centers. And this I wasn't aware of. There's actually a lot of infrastructure projects going on that has really seen some exceptional growth. These so-called mega projects, that a lot of these are being driven in large part by congressional funding acts. So there's one that I didn't know about, that this was something new that was going on. And here's the other. Supply chains got significantly worse for large electrical equipment because of this. This is such things as large transformers, switchgear, and generators. It appears there's some lead times on the magnitude of 1 to 2 years for some of these items. The other big concern right now is cost of labor, as there has been some changes going on here. And it all has to do with the unemployment rate and how competitive the labor market is. So a lot of private projects are still looking at concern about the federal funds rate. There's a lot of talk about this. We talked about it recently. The Fed has really been pointing towards that they're looking to start cutting rates. How fast and how far is still a big question. And does this mean that maybe we're just looking to see slightly lower rates in the near future, or will there be significant changes? Nobody really knows. So diving into the rest of this issue, we're going to talk a bit about U.S. construction costs, some of the leading indicators in the construction industry, construction spending, backlog indicators, and again, back to employment, because this has a big impact on construction labor. And then we'll get into some of the components of heavy industrial construction. So the Fed rate pivot, federal funds rate, has been at a 22-year high in the 5.25 to 5.5 range. That's interesting for me to hear, because it sounds like a long time. And this is dating back close to the turn of the century. I'm still one of those guys who feel like really since 2000, a little before, we've seen artificially suppressed rates. And the question is, am I wrong? Are we going to just be in a lower rate environment overall here? And rates will come back to things that previously were considered to be astounding lows, or will we stay more in this range we've been in? That's what we're going to find out over the next few months when we see what the Fed does. What does that have to do when we're looking at bigger projects and whether people are building new projects? A lot of these are dependent on where they can finance them. The other thing that falls in with financing is, our banks ready to lend? Part of the cutback in building has not just been that rates are higher, but also banks have been less willing to lend, making it harder um, to get lending for these bigger projects. So let's go on here now to labor costs and labor shortages. The industry labor shortages to meet demand have been the most pressing issue for most construction companies around the country in the last few years. It's welcomed by the workers to see rising wages and abundant work opportunities, but construction inflation has shifted away from material and towards the labor component of cost due to increasing retirements from aging construction workforce coupled with reduced interest from younger generations. There's continued strain. Now, this is really interesting because I have kids in my who are just pushing 20 years old, and as they're heading off to college, they're talking to kids, and I see these things come from colleges. They're like, our average graduate makes. I've never seen one over $55,000 a year. So it's usually somewhere between $50,000 and $55,000 a year, and they're promoting this. But at the same time, I see billboards promoted looking to bring in apprentice electricians and HVAC workers where they start at over $70,000 a year, and many push up towards $100,000 a year after they complete like 6 months of training. So you can have a kid who's not even 19 years old pushing towards making six figures while his peers are off at college putting away, $100,000 or more in educational debt to come out and get a job that makes $50,000 a year. Now, when you do the research, I know this is one of my favorite topics because it's always been promoted that you see these things that say college education increases X amount over a worker's lifetime, and the number had always been like $1 million. But you see this, but very few times will you see somebody go into deeper dive on this, because if you take out the highest earners who require a college education, and that's doctors, lawyers, architects, the highest paid professionals, that number, even historically, went to where there was really not a lot of difference. And in the labor market we're in today, especially when you look at the trades, that is completely getting blown out of the water. Um, and this is, I mean, there's a great opportunity here, especially I've met some young guys who are working in the trades, and they're also becoming investors and becoming real estate investors. And they're kind of got this inside eye on what's going on. And so they're making great money. They're starting to invest young. They're beginning to own properties. These kids are going to be hard to catch by the kids coming out of college. Um, but anyway, so there's my little sidelight on the escalating labor costs and the construction. Um, this is still having an impact on trying to get projects done because construction costs are high. These will continue to probably stay high until we see a slowdown in building. If we get some sort of recession. So moving on, what's going on with the government? So we got the CHIPS Act, the IRA, Inflation Reduction Act, and the Infrastructure Investment and Jobs Act. So according to Deloitte, public investments in non-residential sectors facilitated by these acts offer job opportunities. However, the increased demand in related construction sectors is creating some challenges, such as restricted labor resources that aren't keeping up with demand, along with persistent struggles and long lead times for large electrical equipment like transformers and switchgear. Um, Another big thing that's going to affect this is generative AI. Engineering and construction firms and construction technology companies are actively researching the capabilities of generative AI to improve efficiencies and are also exploring solutions to leverage this technology for their specific business requirements. We had some shows a while back with Vanessa Alfaro, and she came on and talked a lot about AI, and she's really been big in this area. One of the big areas of opportunity in generative AI is not out there developing actual AI, doing the programming, doing the technical part, but it's going to be the adaptation of it into industry and consulting to help companies and individuals learn to use this and keep up, because people who aren't using it are going to fall behind, and the rate at which it's improving is extraordinary. So it's interesting to see. This is the first time that I've seen this really in this kind of nuts and bolts area of construction, that they're starting to look to where they can use generative AI. And this is going to be disruptive in the job market. A lot of jobs, especially if people are doing redundant work, are going to go away. They're going to be taken over by AI. But on the other side, it's going to create whole new jobs. And the people who get in front of this are likely to do very well. So moving on, U.S. construction costs continue to hold steady at significantly higher than they were pre-pandemic, but we're seeing some of that rate of rise stabilize a little bit. January 2024, the construction cost index, as reported by Engineering News Record, is 2.6%. The building cost index is 3.8%. And material cost index is 4.5%. So we're still seeing that materials are a big part of this rise in cost. The cities with the highest construction cost increases were Chicago and Los Angeles at the top, followed by Cincinnati, Denver, and Pittsburgh. After spending the last decade in the Midwest, it's a little bit of smile on my face to see the Midwest doing well with Cincinnati and Pittsburgh in there, because if they're seeing increases in construction costs, that means their economies are doing well. And there's some great things, especially going on in Northern Ohio right now. So some of the leading indicators of the construction industry, these are showing mixed signs of slowing, which may be offset by projects coming down the line as a result of congressional funding acts. So some of the indicators here, a key one is architecture billings, or what are architecture billing firms, or architecture firms billing out, which kind of shows new programs, or sorry, new projects in the pipeline. Right now, it's a bit below average, indicating a slowdown in billings, which can be an indicator of decrease in projects coming here in the next months to year. Total construction spending, though, is still 11% higher, and private construction spending is 10% higher than a year ago. According to the U.S. Census Bureau, the total construction spending for November 2023 is still 11% higher than a year ago. Look at construction backlog, or the construction backlog indicator, has been up on a monthly basis, but is down on a yearly basis. So again, we're getting some mixed signals here that we're not really sure about. Construction employment continues to gain jobs, while construction unemployment is at 4.4%. A tight construction labor market continues to create issues of finding enough construction workers. Total construction employment had gained jobs through the end of last year. Total building construction employment and specialty trade contractors continue to show growth in construction employment, although this appears by some of the indicators to possibly be slowing down. Construction labor costs, though, continue to rise, especially in major metropolitan areas, and specifically for the more skilled labor in the construction trades. Um, Material inflation, as we talked about a little bit earlier, this has started to come down from its peak. Some of this has just been a stabilization of price. So inflation is coming down, but it doesn't mean prices are coming down. Prices are just starting to stabilize. Um, Asphalt prices actually took a dip here in the last 12 months. Those are stabilizing again. Concrete pricing, though, continues to rise while reinforced steel prices show a decline. As of December 2023, ready-mix concrete prices are still up from a year ago. If anybody out there has been trying to build anything, concrete prices have really just been a deal killer sometimes, especially if it's a project that requires a large amount of concrete. Structural steel pricing, the price of steel has begun to cool. This is good news for people looking to any construction prices of any size. And we were trying to do our office and ASC project a couple of years ago. Steel prices were one of the biggest things that were so unpredictable, and were going up so fast that it made it really hard to price out the project. At every stage where we reached the end of it and we repriced it, steel prices ended up killing the addition because it just made it unaffordable. So this is good news for people looking at projects that are going to require um, structural steel. And finally, in our review, piping prices. Looking at all the different types of, I think digging into the details of piping is probably beyond the scope of this podcast, but still across the board, seeing an increase in the price of all types of piping. Corrugated steel looks like it's up the most, but across the board, that's still having an impact on new projects. So, what does this mean for commercial real estate as a whole? Well, it means that new projects are still expensive, and it's still can be tough to get projects done. We had a recent discussion about industrial building here in Salt Lake City, and that's really between, land prices skyrocketed during the pandemic, and construction prices have gone up. Although there's huge demand, a lot of projects are still really tight as to whether they can pencil out and get done. What does that mean for us as investors? There's a lot going on in the industrial investing market right now. It's kind of become the new hot thing. I've seen on a lot of at least a couple of the crowdsourcing or crowdfunding platforms out there for commercial real estate. And I heard recently that for one of these, the number one group that is investing on these platforms are doctors. Um, these were platforms that when I started my real estate investing journey, was all multifamily, and it was really where I started investing. The reason I started investing there was kind of this, the risk benefit ratio of I wanted to get in the game. I needed to start investing because until I did it, it didn't sink in for me. The learning wasn't the same. Not being in the game is in the game. And there were a lot of multifamily projects that were promoted as being absolutely incredible. And but they had low entry points. So, you could invest $20,000, where with a lot of the bigger private developers, they're looking for $100,000 investments. So I invested in a good half dozen through there, and a significant portion of those were people who were new to multifamily and kind of came from some other places. And out of those, looking back, working through some tax stuff, um, most of them have still paused their prefs. The number of capital calls has continued to increase. I didn't see many for the first um, couple of years as things started to change with higher interest rates, but I've seen more capital calls now. So I guess I've got a mixed impression of these platforms. These platforms are rushing to industrial real estate now. I see the emails all the time. They got all these industrial deals, and it just kind of makes me wonder. I love industrial real estate, but right now it's the hot topic, and there's probably a lot more value investing in multifamily right now because prices have changed. So that's what I guess I just say, when you're looking at these types of deals, um, ask the tough questions. The tough questions will be one on financing and what are they planning on doing with their financing? Because most industrial deals get signed to long-term leases, meaning 5 years is a short lease, 10 to 20 years is a long lease. Um, and I think the really reputable sponsors here should be doing financing at least in the same range as the leases. So if they're doing short-term financing, and right now you're going to see more people bragging about long-term financing, is what they're hoping to do is refinance at lower rates, anticipating rates coming down. Um, so there's something going on with the industrial world. We look at construction across the board. Construction prices are still high. And that means the people who are going to make new construction work are a lot of the really the experienced pros. It's not an easy place to make things work now. So if you're looking at investing in something that's new construction, uh, ask hard questions and maybe ask them also, like, what are the things that you're not asking when it comes to industrial real estate. The things we talked about here are important. Big ones here being what's going on with their labor costs. How have their labor costs been changing? How long have their employees been with them? If it's a company with a lot of turnover, they're going to see a lot bigger impact by changes in labor costs than somebody who have long-term employees. And often what happens with long-term employees is they may not have to keep up with every fluctuation in the labor market, because if they really treat their employees well and they make it a great place to work, their employees aren't shopping around as much, and they're going to have more stable costs over time. Um, Ask them about their if it's a bigger project, their big electrical equipment, since that's one that still has long lead times. If they've got their orders in, what they expect, and if they don't speak of there being any issues with that, that's a good point to ask more questions and ask them if they've already got that stuff ordered or delivered. Because that's really about the only way to make sure you don't run into issues with that is if you already have it on hand. The other things we talked about today, um, prices, big one being concrete. Concrete's one that still hasn't come down. So if it's a project that requires a lot of concrete, inquire about their concrete pricing, and is that pricing locked in, or is there still some variability for them there? So I hope this is beneficial for you, and thank you for joining us here on Surgeon Syndicate. Please join us for our next episode, and we'll see you then.
Do you care about paying too much in taxes? And would you like to save more of your hard-earned dollars? Here's what we found. We found that most financial professionals have a one-size-fits-all solution. So the question is, would it make it easier for you to have someone tailor your tax solutions to your individual needs so you can keep more of your money and do what you want with it? That is exactly what we do at 𝐥𝐸𝐿.
As surgeons, we know the difference between routine surgery versus life-threatening interventions. And I want you to know that I've used 𝐲𝐸𝐬 and her team for my personal financial intervention, and I love the results. I would do you a disservice if I didn't recommend them to you.
We'd love to help you, so let's jump on a call and see how we can collaborate. Simply go to www.𝐥𝐸𝐿.com/McManus and book your free call today.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.